Welcome to our physician homebuyer class. I know that your time is really limited. If you are anyone who is coming to this class, you're in healthcare or you're a physician. And so I really appreciate the time that you're taking to come to this course because I know how limited your time is. So I'm going to try to make it as pertinent as I can, give you some kind of quick hitter information, and hopefully at the end of the day, you take something from this course, and I hope that it translates into you saving money or just feeling more prepared overall about the process of purchasing a home that happens for you. A quick introduction. This is me and my husband, Jacob. He is a fourth-year anesthesiology resident at the University of Utah. And I was telling Katie before that he's in his last year, but we added a fellowship. So you know how that goes. The training never ends. We have 4 girls. They're super adorable. And we have been in Utah for all of our medical school training. He did his medical school at the University of Utah. We did our residency at the University of Utah. And now we're doing fellowship at the University of Utah. We're unique in that way that we've stayed in the same place for all of our medical training. And this little video that is playing in the bottom right-hand corner is the home that we purchased over about a year and a half ago during residency, and we completely remodeled it, my husband and I, and with the help of his dad. We redid the whole house. 10 out of 10 do not recommend that you do that during residency, but it was a process that we went through. So we've recently gone through the home buying process ourselves as a physician family. And as you can imagine, we were pretty financially incentivized to make sure that we were trying to get the best deal that we can and that we were doing the process right. So that's a quick kind of personal intro about me and my husband. He usually tries to teach this course with me, but unfortunately he's tied up tonight. He might be on Zoom, but he's in and out of the OR. So a little bit about more of the professional side of why I and my husband have the cred to teach this course, besides us being a physician family and being incentivized to understand and know this for ourselves. I have been a real estate broker in the state of Utah for over a decade. I am a top producing realtor who primarily services physicians. Just to give you numbers, this year I've done about over 20 million in volume. And so I am doing this day in and day out. I'm helping primarily healthcare professionals and physicians, nurses, dentists, all the people who fit into this niche of healthcare to purchase homes in the state of Utah. So I've got a lot of experience on what works, what doesn't work, just from all of that. Also, for 8 years, I was a mortgage loan officer, which is the person who is in charge of your loan when you decide to get a mortgage. And as a mortgage loan officer, I had to learn how to interpret my competition's quotes to figure out how I could beat them and how I could get more clients, because I didn't want to lose clients because my quotes weren't as good. And what I've done over the years is I have passed that information along to the community, to my clients, just to everyone online, anyone who's ever asked questions about buying a home, with how to shop for a mortgage and all of those things. And as you can see, we've got a lot of good positive feedback over the years from this course that we've taught, so much so that we've taught this course to hundreds of medical students, residents, attendings, just all different kinds of healthcare professionals across the country. And we've created a business for it called Real Estate Unmasked. And it's what I'm doing tonight with you. We just teach and help healthcare professionals to try to understand and get an edge on all things real estate. So there's going to be a lot of things in this course tonight that I'm not going to be able to have time to cover. I'm going to try to keep this course only to about an hour. There are so many things that you can be learning about this, and there's going to be some questions that I don't answer for you tonight. The good thing about it is we have created this website, Real Estate Unmasked, that has pretty much every high yield question that we have had people over the years ask us about buying a home as a healthcare professional, anyone who can qualify for like a physician loan, which I'm going to get into that in a little bit more about what are some of those perks that you can get from physician loans along with the whole process. So if for whatever reason after tonight you're not able to get some of your questions answered, you can get on our website, you can ask us a question there, you can shoot me an email. It's pretty easy. This website is not live 100% yet. You guys are some of the first people who are going to be able to see this website because we have not published it publicly on Google. But if you were to just type in your search bar www.realestateunmasked.com, then you can get to this website and browse all of these different questions to help you out if we don't cover something that you need specifically in this class today. So with that, I'm going to go ahead and get into the meat of this course. And I like to start with a big picture view and then zoom into each part of the process of buying a home and getting prepared to do it specifically as a healthcare professional. So I'm going to use this timeline to guide us throughout this slide deck. We're going to start off with where you're at right now. If you're attending this course, you're probably thinking about purchasing a home within the next year, 6 months or so. You might still be debating renting, but you're just trying to get more information. So we're going to try to give you some of that tonight. So if you're 6+ months out, you're probably working on negotiating a contract with your future employer if you don't have one already signed. Or if you are a medical resident or a fourth-year medical student, you're getting ready for match day and trying to figure out, what do I need to be doing now to prepare so I could purchase a home if that's the route I decided to go. So we're going to get into some of those details. First thing that you should be doing, if you can, is saving up for a down payment. That's a no-brainer. But one of the perks of physician loans, which I'm going to get into more detail in a later slide, is that physician loans, you can get 0% down, meaning that you don't have to save up for a down payment. As a medical student or any kind of student, pharmacy, dental, we're all in so much debt and we're spending all of our time going through school and dedicating ourselves to that. Most of us don't have an income during that time. So purchasing a home right after that is impossible. You have to have a down payment. But if you do have funds, if you're not in that subset of people and you're an attending, or you already own a house and you're looking to sell it, as you have more down payment, your rates get better. As you save up 3%, 5%, 10%, 20%, your interest rate will get better. These numbers aren't exact. They're just ballpark numbers of what I saw when I was a mortgage loan officer of what the difference is between different rate brackets. Now, the unfortunate thing is that if you decide to put 4% down, you're not going to get a middle in between rate. These rate brackets are very stiff, meaning like you could have 4.99% down, but you're still going to be getting the 6.125% rate. So if you're aiming for certain down payment amounts, these are good tick marks to try to aim for because they will actually affect your rate to help you get a better interest rate on your mortgage. So there's different types of compensation plans that you can get when you are negotiating a contract. Most people are compensated by W-2. If you are a W-2 employee, you pretty much got the green light to purchase a home up to 90 days before your job starts. All residency programs are W-2. So if you are a resident or if you're looking at matching, you're going to be W-2. I have had some residents that I've helped homes that they have matched and they have put an offer on a home on match day. I would probably not recommend that, but it is possible to do if you really wanted to, and if you were prepared beforehand. With a traditional conventional mortgage, if you are self-employed, you will not be able to get a mortgage on a home without having a whole year of tax returns filed. One of the perks of physician loans is the fact that if you are going to be compensated 1099, if you have like a wage guarantee, like X amount of hours for X amount of dollars, or if you have a base salary guarantee and then based off of performance or patients or bonuses, then they can qualify you based off of that. So that's more of a yellow. Red is a partnership. If you are joining a partnership or you are K1, likely you're going to have to wait 2 years to buy. I can't tell you how many times I have a client come to me and say, hey, we just signed our employment contract. We want to buy a house. And then they send me their employment contract and I see that they just signed a K1 partnership. And I say, guys, you're not going to be able to buy a house for 2 years. And they are upset. They're like, man, I wish I would have known that before I signed this contract, because that might have changed the way I viewed which job I wanted to accept. So that's one of the reasons I bring this up. This is red, but it is also good to point out that these are general rules and they're not set in stone. So for example, here in the state of Utah, because I work with physician loans quite frequently, and because I primarily work with the healthcare sphere, I have actually found lenders who will lend on partnership contracts. There are certain stipulations that have to be met. You have to have a down payment. But if you find a local expert in physician real estate or healthcare real estate in your area, you might be able to find a way around these things. Credit mix and meaning. Most of you guys, if you're on this Zoom meeting, you probably have really great credit. I'm preaching to the choir here. So I'm just going to breeze through this slide. And if you need more help with credit stuff, you can go to our website or you can send me an email and I can talk to you more about specifics. But if you're looking to get an 800 plus credit score, the data and the research shows that people who have 800 plus credit scores are only using about 7% of their total given credit at any given time. They're revolving credit. So if you have a credit card that has $1,000 credit limit, you don't want to be putting more than 7% of what your total credit limit on between all of your cards is at any given time. So if you only had one card that was $1,000, you wouldn't want to be putting more than $70 on that at any given time. Once you start putting more than 30% on a card at any given time, that will start to decrease your score. Now, your score is really fluid and it can change quite drastically month to month. So in general, trying to keep your credit in those usage ratio numbers is going to help you. Now, when you're trying to qualify for any kind of specialty loan, like a physician loan, you have to have higher credit. Most of them, you have to have a 720 credit score or above for your qualifying score. The way they figure out what your qualifying score is, they pull something called a tri-merge credit report, and they will take not the highest, not the lowest, but the middle score to qualify you for the loan. If there are two of you on the loan, then they'll take the middle score from whoever has the lower score, and that would be the qualifying score for a loan. All right, 6 months. When you're about 6 months out from purchasing a home, this is the phase that I call get connected. So getting connected includes if you want to use a realtor, then trying to find a realtor. If you are part of the 70% of the population that needs to get a mortgage on, I'm assuming that if you are here tonight, most of you are going to need to get a loan on a home. And so that is also when you would want to start the pre-qualification process and trying to find loan officers as well. I'm a realtor, so obviously I'm biased, right? And so take what I have to say with a grain of salt. There are some situations where it could possibly be advantageous for you to not use a realtor. The biggest thing is you may miss out on a for sale by owner, because a lot of for sale by owners decide that they do not want to work with realtors, period. And so with people who want to work with me, I say, hey, if you want to find a for sale by owner, you can try that route yourself. And then if it doesn't work out, then come to me and we can start searching for homes. 90% of all homes in the United States are listed by realtors. There's a 1 in 10 chance that you might find a for sale by owner. But just because it's a for sale by owner doesn't mean that it might be a deal. Then the other con of having a realtor is it could potentially cost you money on the buyer side. Now, traditionally, the structure of a buyer agent realtor is that the seller covers the buyer agent realtor's commission. So traditionally, they used to say that as a buyer agent realtor that your services were free. Now, the FTC came and said, no, you can't do that. You can't, that's false advertising because your services are not free. The seller is still paying for the services. But there are still some situations where using a realtor could cost you some money. In the next slide, I'm going to talk a little bit more about how we can mitigate this part of it to make sure that when you're using a realtor, you understand if they're going to cost you money, or you can try to negotiate with them and make it so it doesn't cost you anything out of your pocket, depending on who you're working. One of the reasons that I mentioned getting in contact with a realtor, if you do decide to use a realtor, before a mortgage loan officer, especially in this healthcare field, is because of the contacts that realtors, if they are a good realtor who specializes with working with physicians, which we have a network of us across the country. Most of us are married to physicians or we are in healthcare. We have a network of us across the country who get it, who specialize in helping people with buying homes. I bring this up just because I had a client once who heard that KeyBank did physician loans. So before they got connected to me, they walked into a local KeyBank office and they talked to a loan officer and said, hey, do you guys do this doctor mortgage for healthcare professionals? And the guy at the desk was like, yeah, we do that. And so they did an application, they got pre-qualified, and then they came to me And they said, yeah, we've already been pre-qualified for a physician loan. I said, okay, who did you talk to at KeyBank? And they told me this random guy that I had never heard of. And unfortunately, the policy at KeyBank was that whenever you start a process of a loan application with a certain loan officer, that loan officer gets to keep you no matter what. Now, I work with physician loan lenders across the country who do them nationally. They are doing hundreds of loans like this. And because they do such a high volume of those loans, the banks give them special incentives that not every other loan officer across the country does to help them market it. I work with Michael Durepsi at KeyBank quite a bit because he's one of the couple of physician loan professionals. I work with him, and unfortunately, they couldn't transfer their application over to him, and his rates were a whole 1/4%, and his closing costs were about $3,000 less than this other Joe Blow guy at the local KeyBank branch, because he got special privileges and perks because he's the physician loan guy at KeyBank. And so that's one of the reasons why I say it's important to first get connected to a realtor and then take their recommendations, always with a grain of salt, compare them to what you've seen, so then you don't shoot yourself in the foot like one of my clients did in the past. So this slide is some of the questions that you should be using to interview your realtor. When you're working with a realtor, most of them will want you to sign something called a buyer-broker agreement. That agreement is a contract saying that that person is going to be your dedicated realtor for a certain time period, and it's really hard to get out of. So you could ask them, if they do require a buyer broker, to say, hey, can we do a 2-month trial period and then we'll sign a longer one? We feel comfortable. Another thing that it's important to ask any realtor that you work with is, do you help healthcare professionals purchase homes? There are so many nuances and benefits that strengthen your offer when you're trying to purchase a home because you fit in this healthcare niche. The types of loans that you can get are a strength. If you're working with someone who's never heard of those or doesn't work with physicians, they're not going to understand those nuances. So when a seller agent realtor comes at them and says, what is this? They're not going to be as strong as an agent for you, representing you in your unique situation. After you've gotten connected with a realtor, you go get pre-qualified, find a loan officer. To be able to get pre-qualified for a loan, you need to be able to provide them these documentations. Now, a lot of the times you're not going to have an employment contract. If you are a 4th-year medical student looking to match, you won't have it till after match day, but you can get pre-qualified. I like to call it a soft pre-qualification. You can just give them estimate ballpark numbers. They might require some things, like they might want to see some bank statements or a tax return or something, but a lot of the times they don't actually need these hard documents to give you what I call a soft pre-qualification, which is essentially you getting online, typing in your information of what you estimate these things to be. Then they pull your credit to see what your credit score is and how that affects your rate. And then they can give you an estimate on what you can afford based off of that without needing all of these documents in hand. When you start the actual loan process, when you're actually looking to buy these homes, they will need all these hard documents. But I usually recommend people get a soft loan pre-qualification with one lender about 6 months in advance. And the reason I recommend that is because credit can be so finicky. In the last year, I've had 2 clients who were like, oh, my credit's golden. I look on Credit Karma and it says I got a 720 credit score. And then they go and get this soft loan pre-qualification 6 months in advance, and they find out that they have fraud that they had no idea about, and their credit is actually a lot lower. Or they go and they find out that there was some medical collections account that they paid off and they closed, but for some reason it got reported to the credit bureaus for the last 4 years that it was never paid. That kind of stuff takes time to fix. And if you get a soft loan pre-qualification 6 months in advance, then you know that, hey, I'm safe. And if something comes up, you have some time to start working on getting that fixed before you actually want to be in a home. Once you're about 3 months out, this is what I call go time. This is when you start seriously shopping for a mortgage. That's when you're going to start offering on homes, most likely. And so we're going to talk about some of those processes. This is where I'm going to go into physician loans or healthcare professional loans. There are two different types of loans out there. And unfortunately, when it comes to physician loans, there's a lot of misconception out there that physician loans are bad or they're not a conventional loan. It's just misinformation from people who don't quite understand the mortgage industry. There are only two types of loans: government loans and private loans. Any private loan is a conventional loan. Any government loan is Federal Housing Administration, Veterans Administration, and the U.S. Department of Agriculture, so rural housing loans. I'm not going to go into these at all tonight. So if you have questions about these, feel free to reach out. I'm going to be focusing on the private ones because those are the ones that you're most likely going to be trying to choose between, is a traditional, standard, conventional, conforming 30-year fixed rate mortgage versus a physician loan, which is a non-conforming conventional loan. Now, the reason a conforming loan is a conforming loan and this is a non-conforming loan is because a conforming loan follows all of the guidelines that have been set by the federal government for a loan to be bought from a private institution and then packaged by the government into real estate investment trusts, REITs, and then sold to the public as investment. For a loan to be bought from a private company, it has to fit all of the conforming conventional standards that the government sets to be bought in the secondary real estate mortgage market. Now, non-conforming mortgages most of the time meet about 95% of all the same guidelines that a conforming mortgage meets, but 5% of things that make them not eligible to be bought by the government, which means that the private conventional bank that is lending you that money is keeping that loan, servicing that loan, collecting the interest over time, and they are the ones who are betting their own money on you, which means they get to set the terms a little bit more and they can be a little bit different than what the government is trying to get you. In healthcare professional loans and physician loans in our sphere, this is a positive thing. It means the perks of doing a physician loan help you to get a better deal on a mortgage if you choose to use a physician loan. I've already mentioned some of these things in previous slides, that you can get a 0% down, that rates get better. They're a little bit more lenient on employment stuff. I'm going to focus on some of these things that I haven't quite touched on yet. One of the biggest benefits of doing a physician loan, healthcare professional loan, versus just this normal standard conforming conventional loan is there's no private mortgage insurance, even with 0% down. This is one of the main reasons why a mortgage will not be bought by the government. There's no private mortgage insurance. We don't get an extra big paycheck if they default. We're not willing to take that risk on. Now, you can go to any bank downtown and they will tell you that they have a no mortgage insurance option. There's a difference between a borrower paid mortgage insurance, which is monthly mortgage insurance, and a lender paid mortgage insurance. As a mortgage loan officer, if you said that you didn't want any mortgage insurance, I could do that for you. But what it meant is there was an upfront cost that you had to pay, a couple $1,000s more to essentially pay your mortgage insurance up front. What that resulted in is you getting a higher interest rate, usually by about 0.5%. So there are places out there that are going to say, yeah, we're a physician loan, we don't have mortgage insurance, but it's actually lender paid mortgage insurance where it's wrapped into the interest rate. The awesome thing about actual true physician loans, if you shop around, is the fact that there's not even a rate hit. They don't bump up the rate, the 0.5%, to help cover that extra cost of the mortgage insurance. They keep it arbitrarily low because they're trying to gain your business. So that's a huge benefit of getting a physician loan versus a standard conforming conventional mortgage. The other thing that is a benefit is you're avoiding jumbo loan territory. So for example, in my state, our jumbo loan territory hits around $700,000. If you need to get a loan for more than $700,000, you're determined to be more high risk to the government. And so they charge you a higher interest rate, almost 0.5% to a whole percent more than what it would be if you stayed below that threshold of the $700,000. And it varies county by county and state by state what the government has set for the jumbo loan limit in your area. The cool thing about physician loans is they don't have jumbo loans. They just have their normal set rates. So if you're doing a loan up to 1 million for 0 to 5% down, even if you get a loan for 800,000, you're not getting penalized for being in jumbo loan territory, because to them, it's not a jumbo loan. They're lending their own money and they're willing to make that risk. So your rate is arbitrarily lower. If you shop a normal conforming conventional mortgage, which I recommend everyone does, and then you compare it side by side next to a physician loan, the number difference is hundreds of dollars less a month, with a combination of not being a jumbo loan and not having mortgage insurance. And you're saving thousands in closing costs. You don't have to take my word for it though, because I'm going to teach you how to shop around in these next slides. Shopping for a physician loan. My rule is you should always try to get 3 quotes. You should try to make at least one of them a physician loan. You can take the recommendation of your realtor and try that person, 1 of 2 of their people out. And then also you should go find someone completely outside, someone who's not associated with your realtor, someone who's not a physician loan. Just ask your community and say, hey, can you give me a recommendation for someone who did a good job on your mortgage? Because then you are truly shopping around and getting unbiased information so that you can make a decision that hasn't been steered in any way. When you're getting quotes, you don't have to get pre-qualified, meaning you don't have to submit all the documentation every single time to every single person you get a quote from. You can just ask for a quote, and I'm going to show you how to do that in my next slide. But the reason you want to shop around is this. When I was a mortgage loan officer, the biggest difference in someone getting a better rate or better closing costs was how much an origination fee is. For the people that you see on billboards, they have to pay for their marketing costs somehow. So they're charging sometimes almost double than if you were to find like a mom and pop shop. And so that's why it's important to shop around, because then you can compare and see. Unfortunately, this is not as easy. A quote doesn't come to you like this. That would be really nice if it did. In the next slide, I have an email template that you can copy and paste and use to ask for quotes. A lot of places are going to say that they don't have origination fees or that their origination fees are minimal. So don't fall for that. No one works for free. Everyone has an origination fee. The other thing that you want to do is, even if you're thinking about doing a 0% down program, typically you're going to need to budget 2 to 3% of your loan amount. So you have the cost of getting the house, which is your down payment, but you also have to pay mortgage loan closing costs. Now, 6 months ago, when I was teaching this class, there's absolutely no way I would have talked about this part that I'm going to tell you, because it was COVID and this was not happening. But the market is cooling in the United States right now because of the interest rate hikes that have happened recently. It's getting harder to sell homes. And because of that, you can actually have your realtor negotiate some of these closing costs. You could ask the seller to pay for your loan closing costs for you. You could do 3%. Now, it's important to note that some lenders have overlays that say you can't get any more closing costs than what you put your down payment as. So it's important for the bank that you choose to work with and your real estate agent to be constantly talking about what is going on and what you can qualify for and what kind of offer is okay and how it affects the financing. Okay, this is the template that I send to anyone when they're shopping for a mortgage. This is the way that you are able to key in a mortgage loan officer that you know what you're talking about. You're not just some Joe Blow down the street who's never got a mortgage before, and they can just upsell you and make you buy the highest priced car on the lot. If you send an email like this, it signals to your loan officer, I am educated on the lingo. I am educated on how to shop for a mortgage. And so just simply by sending an email like this, they're going to put their best game face on. And I bet that they are going to give you a better rate. Because if I received an email like this when I was a mortgage loan officer, I would say, I got to cut my costs as much as I can and try to get this person, because they know what they're talking about and they know how to shop for a mortgage. I teach a whole 1-hour course just on this slide. And that course I've already recorded and it's on our website. It's underneath the How to Shop for a Physician Loan page. So I unfortunately don't have the time to go into details about this slide in this class tonight. But I would encourage you to get on our website so you can watch that video if you want to learn more about how to shop specifically for a physician loan or for any mortgage. This applies for conforming conventional, applies for FHA. But by using something like this, it's just going to help you get ahead. When you're 3 months out from purchasing a home, that's when you're wanting to do your heavy shopping around process. You're looking at mortgages, you're comparing the quotes, you get a hard pre-qualification. That's where you start sending them all of your documents, your employment contract, everything. I'm a big fan of keeping my personal information away from as many people as possible. So that's why I like the shopping around process, is because then once you've picked someone, then you can give them all that documentation so it's not out in 15 people's hands. The other thing that you're going to start doing in this 3-month process is chatting with a realtor, and you can start this process as early as 6 months out. I actually kind of recommend people do chat with a realtor 6 months in advance before you're actually going to buy. Now, that might seem a little overkill, but in my experience, it's actually quite just right. It helps you to get educated on what the market is doing in your area. So for example, if a realtor sends you a home 6 months in advance and you say, man, if I was ready to buy right now, I'm pretty sure I might put an offer on that house. Then what you could do is say, hey, realtor, I want you to keep track of that house. I want to see what it sells for. Does it sell above price? Does it sell below price? Did they get loan closing costs? How fast did it go under contract? If you keep on doing that process all the way up until when you're ready to put an offer on a home, when a home that you like comes up, you're not going to be like, oh, let's lowball them by $50,000. And your realtors, that's not really what houses are going for right now. You could definitely try it, but you have a bunch of background information from all the months of searching. You have all that background information to help you make a more informed offer process decision when you are actually ready to offer on a home. Now, once you have offered on a home and it's gone under contract and you are ready to move forward, it's a false start. You're like, cool, I got under contract on a home, but there's actually about a 30-day period where it could all still go south. And this is the general process of what it looks like. Once you've picked a house, got under contract, you're doing all of these things during this 30-day period. Within the first week, you are doing an earnest money deposit. An earnest money deposit is a show of good faith. It's called different things in different states. Like in the South, it's called a due diligence deposit. You're going to be working on your loan through this process. You're going to be ordering an appraisal. Usually it's recommended to do a home inspection. You're still working on your loan, getting them more documents that they're asking for. And then usually within 4 weeks or a month, everything's done. Everything's been figured out. Everything has been sorted through and you're ready to purchase the home. You go and you sign your loan documents. And then you still usually have to wait a day after you've signed your documents until the house is officially yours. So that's the process of what it looks like when you actually buy a house and what you're doing during the contract period timeline. Okay, I'm going to do a current market analysis for you. I'm going to talk about home prices and interest rates. These are general numbers for across the whole United States. If you want to know more about specific Utah numbers, you can stay after the class and I'm happy to chat about those. But I'm just going to breeze through these and just give you a history of what we're looking at for the real estate market right now. So this is a 30-year history of interest rates and home prices. The red line is home prices. So you can see here, anything that is shaded gray is a recession. So right here, you'll see that this was the 2008 big market crash. And when you look at it on this graph, it doesn't look too terribly bad, especially when you see how much prices have gone up since then. This is the 30-year history of rates. So you can see back in the mid-1980s, they were at 18%. So that's why all these grandparents are complaining when we're saying, oh my gosh, rates are so high. They're like, you guys are babies. You guys didn't have to deal with 18% interest rates, but they also did not have to deal with homes being in the $400,000, $500,000 range. So that's just a general overview of what rates have looked like over the past 30 years. On average, between the last 50 years, the average interest rate is actually about 8%. So these last 10, 15 years where we have been lower than 8% has actually been an anomaly. And it's not super common to see rates below 8%. So we've been spoiled the last 10 years. And now this is current market data. So these are the median sales prices of homes sold in the United States. This top graph is a 5-year history. So as you can see, we're here in 2018, 2019, we're just bouncing back and forth. Nothing's really changing. Then the COVID pandemic hit And this is what happened to home prices. And you can't really see it super right now. They're starting to level off, which is good for you guys as home buyers in this market right now. For state of Utah specific, just to give you an idea of what is happening in our current market. Since April, home prices have decreased 7%, and they are currently on the decline. Compare that to like February, March. These are the rates. Right around here, it was nearly impossible to get into a home anywhere in the United States. Then Russia invaded Ukraine, and inflation and recession fears started just boiling over. So the Fed started raising interest rates. So you see that we were right around here at the very beginning of 2022, we were in the low threes. And then all of a sudden, all of this started happening, and we get peaked up all the way more than double what they were in January, all the way up here to about the 7 to 8% range. Now, the encouraging thing that I can give you tonight, news-wise, is that I couldn't give people 6 months ago, is that these rates are starting to come down. A month ago, rates were averaging around 7.3%. Now we're almost around 6.3%. We've almost had a whole rate point decrease just in the last month. And they are saying that the recent declines are due to increasing concerns over the lackluster economic growth, and that the Fed is hypothesizing. You never know what they're actually going to do, but they are predicting that rates are going to continue to level off a little bit more. I don't think we're ever going to be getting back into this range anytime soon. I'm thinking probably more in the high fours, 5, 6s range. Who knows if that's actually what's going to happen, but that's what the trends are showing at the moment for the next couple of months. This is one of the biggest questions that I get from people right now is, man, like I'm 6 months out, but I'm worried that rates are going to shoot back up again. Should I lock in a rate now? I am right about at my 1 hour mark, and I don't want to take up anyone's time who needs to leave. So I'm going to come back to this. I'm going to end the course, and then anyone who wants to stay, if you want to stay, you can ask me questions and I can talk to you about how rates work, locking in an interest rate works, and when you might want to consider locking in a rate if you're afraid that locks are going to go high, or when you should wait. So anyone who wants to stay for that, they can. But that's the end of my course. If you feel like you want more information, or if you need help, or you want to listen to the How to Shop for a Mortgage class, we have a whole website dedicated to this. It's www.realestateunmasked.com. This class is completely free. I love teaching it. I love helping people out. One way that you could say thank you if you wanted to is you could leave a review of the class, mention that you're a healthcare professional, and say it was helpful. I don't buy anything without reading reviews. And if you found it helpful, leaving reviews helps other people to feel like there's cred in coming to the class and helping them out as well. The last thing is also, if you are relocating out of state, and if you would find it helpful to have recommendations for a physician loan or a realtor in your area, we have a whole network of people that we know across the United States, realtors that are like me that specialize in working with physicians. And we know the physician loans across the country, who does them nationally, who does them in certain states. So if you would find it helpful and you want a contact information for something like that, you can email me, you can text me, and I'm happy to send you someone. Doesn't mean you have to use them, but if anything, it's a connection that you can use if you have no one to help you out.
I have a quick question.
Okay.
So yeah, just with regards to physician loans, if we so we bought a home like our first year of med school, we just have renters in there right now.
Yeah.
So do we still qualify for that, even though this would technically be a second home, even though it will be our primary residence? Or
yes. So absolutely, you still qualify for a physician loan. So that's one of the awesome things about physician loans is they're not like VA loans. VA loans, you only get the benefit once. You can only use it once, and then it gets, you can't use it as much, or it's not as good. With physician loans, the only requirement is that you can only get a physician loan on your primary residence or a secondary home. A second home means you have to live there for at least 180 days out of the 360 a year. So you can get a physician loan as long as you are moving into your new home as a primary residence. This is an awesome investment strategy that my husband and I actually did on our personal residence that we bought last year. We got a physician loan on the home that we purchased, and we got it at an incredible rate because it's a physician loan with no mortgage insurance at a lower rate because we bought it as a personal residence. One day we might choose to keep this home as a rental and rent it out. But we can still purchase a home as long as it's something that we're moving into as our new primary residence with a physician loan. And we still get to keep the awesome physician loan on our rental property. So yes, you totally can get multiple physician loans as long as you're moving into it as your primary residence. Now, if you start becoming a serial mover, that's a nickname that we give to people when they're trying to game the system. If you start moving every 6 months and getting physician loans, you're going to get flagged and they're not going to let you do that. But you would have to do that quite frequently for them to say, okay, we're done. But anyways, you should be able to qualify for a physician loan.
Awesome. Thanks so much.
Yeah.
I have a quick question.
Uh-huh.
I know you mentioned with physician loans how it's an adjustable rate. The downsides to having an adjustable rate loan, or do you have any examples of maybe a downside to it?
Okay, so definitely. Let me clarify really quick. A physician loan, you can get a normal fixed rate conforming mortgage with a physician loan. So you can just like you could get a 30-year fixed rate mortgage with a conforming conventional mortgage, you can get a 30-year fixed rate mortgage or a 15-year fixed rate mortgage also with a physician loan. They just also offer, on top of the normal conventional mortgage, they do have the adjustable rate mortgage option that you could use. The downsides of an adjustable rate mortgage is if for whatever reason, say you only did a 5-year adjustable rate mortgage term, say your interest rate, if you would have got a normal 30-year fixed rate physician loan mortgage, say your interest rate there would have been 3.5%, but you did the 5-year adjustable rate mortgage. And so you got a lower rate at say like 3% for during that 5 years. The only downside to an adjustable rate mortgage is if you step out of that fixed rate period. Once you step out of that fixed rate period, then the rate can increase. Now, with adjustable rate mortgages, they have things called market caps that your rate is only allowed to increase by a certain threshold a year. So maybe it's a percentage point. So it's not like it could go from a 2% interest rate to a 10% interest rate overnight. They make sure that they have certain thresholds that they can only increase it or decrease it certain amounts a year. And what they do is they base that off of the LIBOR index. That's the LIBOR is the acronym for it. And so that's where it gets risky, is if you are going to be stepping out of an adjustable rate mortgage during the fixed period, I would probably say, man, that's a little too risky for me. I probably wouldn't do it. But man, if I'm doing an anesthesiology residency and I know that I'm not going to be staying in my residency location for more than 4 years, if I got a 10-year adjustable rate mortgage, then I'd be like, okay, I feel pretty good that we're going to be selling this house in 10 years. Now, say the market tanks and you can't sell your house or else you're underwater. So you have to keep it and rent it. That's another reason why the adjustable rate mortgage might get a little bit scary, is maybe you have to wait a couple years for the market to come back up before you can sell. And if you have an adjustable rate mortgage and it starts to step out of that, then you would, worst case scenario, you could refinance to whatever the current market rate is, but then you're taking a bet on the current market rate. A fixed rate conventional mortgage is the surest bet to know that I'm going to have this payment for perpetuity for 30 years. It's not going to change. It gives you peace of mind. And so those are the two areas that I could find a adjustable rate mortgage being a little scary if you fit one of those criteria. Now, a lot of the times, if you do decide to stay in a home and you get the 10-year, but you only need 4 years, you have a pretty good buffer. In the worst housing recession we've ever seen, 2008, it took 6 years for it to reach back up to pre-recession values. So if you're trying to be conservative and say you have a 4-year school, you're a CRNA, you're a pharmacist, you're in dental school, and you're like, okay, I want to get an adjustable rate mortgage because the payment's lower, the rate's lower, but it's a little more risky. But hey, this is only a 4-year thing. If I get the 10-year one and the worst recession said about 6 years to recover, maybe I feel a little bit better about doing an adjustable rate mortgage, but it's still a risk. And it's a risk that you should talk with your mortgage loan officer in a lot of detail about. A lot of us do the adjustable rate mortgage.
Awesome. Thanks so much.
Hello, this is Gislin. Hey, I have a quick question about if you were to get a physician loan, are you allowed to, let's say, purchase 2 properties with your physician loan? One you can put on for rent and one property that you can live in. Is that something that's allowed?
So you can't buy an investment property up front with a physician loan. They won't do that. They will only do it for a personal residence. So the only way that you can get a physician loan on an investment property is to buy the investment property first and live in it as your personal residence. And you have to have the intent to live in it for at least 6 months. Or else if you have the intent to live in it, then less than 6 months and then rent it out, technically it could be mortgage fraud, which you don't want to mess with that. So if you're trying to get an investment property and get a physician loan and get this awesome deal on it, then you have to move into your investment property first as your personal residence, and you need to live in it. And then after at least 6 months, then you can consider buying another property, the property that you want to live in, and moving into that as your new primary residence, and then keeping the other one as a rental. So that's the way you could do it. You couldn't do both of them at the same time. You would have to do them separately and do it in that order, or else you would risk mortgage fraud.
Thank you so much. It makes sense. Thank you.
Awesome. Okay, any other questions?
I know you talked a little bit about the Utah market, but I'd love an in-depth update of what your thoughts are of where it's headed and timing of when it would be a good time to buy a house. That was great. Thanks.